How are markets affected by RBA meetings? LJ Hooker's National Research Manager, Mathew summarises the intent and likely impacts of decisions by the Reserve Bank of Australia. Cutting rates. The objective of any rate cut by the RBA is to stimulate the economy by encouraging companies and businesses to borrow to invest in their growth. Growth in private investment would in turn see demand for labour increases and boost employment and wages, both of which have been soft over the past 12 months. This would be a positive move for the mortgage holders as it reduces interest repayment costs. However, on the flip side, it also reduces income for the savers that rely on the investments such as term deposits. Effects on the property markets. The initial effect of a rate reduction would be to boost mortgage affordability and in turn lift demand for all property types. This move would have a positive effect on major property markets around the country. Another positive side effect of the rate cut would be the growth of in the construction of new residential projects, and investors and buyers' demand rises for off-the-plan properties. Keeping rate cuts firm. The stability and attractiveness of record low interest rates has had a positive impact on property markets by boosting demand. It also benefited the economy by driving building approvals and construction activity higher. These developments have created jobs and helped shift the economy away from the reliance on the mining and resource sector. The effect on property markets. Keeping the cash rate stable would see demand for real estate remain elevated as buyers continue to take advantage of the cheap mortgages on offer. Price growth will vary across markets, depending on where in the current cycle they sit and the strength of their relative local economies. For example, Sydney is expected to see slightly softer growth due to the strong price growth seen over the previous 18 months, which has driven affordability and yields lower. On the other hand, Brisbane has seen lower price growth over the current cycle, which will now be attractive to buyers thanks to the comparatively high levels of affordability and yields. Increasing rates. One of the key reasons for the RBA to lift rates would be to contain the property price growth. Throughout the past year, strong property price growth has been of concern to the RBA. An increase in interest rates, however, would have seen the dollar increase in value and in turn hurt export-reliant industries. Effect on property markets. An increase in interest rates would slowly reduce buyer demand, particularly from investors as high interest rates. Effects on property markets. An increase in interest rates would slowly reduce the buyer demand, particularly from investors as higher interest rates make other investment assets look more attractive. It also gradually see an increase in the listing activity as property owners sell up to lock in their capital gains achieved during the current growth cycle. The combination of both of these factors would see the price growth cool markedly. Return low interest rates drive investment demand. Thank you from Grant Matterson at LJ Hooker, Narrabeen.